All right, hey, what's going on, guys? So now we are getting into the management, or as I like to call it, the life cycle of a trade. Now, funny enough, this section in itself, like this part of the portal material, is one of the most crucial and most important parts because this actually determines whether the system you're trading is actually going to be profitable. The funny and interesting thing about trading is that you can use close to any system for the most part. Any system that has some kind of edge can be used. And it's really going to be the management and the way that you manage trades, the way you think about trades, the way that you take on risk, take off risk, take partials, whatever it might be. It's going to be how you go about those steps and then executing them, deliberately and consistently, that's going to determine if you're actually going to be profitable long term. So management is quite literally one of the most important parts of the entire trading kind of skill set. And interestingly enough, one of the biggest reasons that I make money in the trading markets is because I keep my losses small, I keep my drawdown small, so that when the wins come, I make a lot of money. And I'm teaching you guys to do the same thing. Now, to start basically laying a foundation in your own mind about how to think about trading in terms of management, in terms of partials, in terms of all this stuff. And we're going to define it all and talk about it right now and then look at rules of it. And then I'll give you my exact rules that I personally use. So then you can go off and either use them as well or use your own. Is to start by talking about the management or the life cycle of a trade. Now, what I did is I made this this took me about 16 hours to perfectly draw. Not really, but most of what we do is simple. Is just that, sometimes seeing it visually helps a lot. But this is right here, the life cycle of a trade. This is ultimately everything that trading comes down to as a skill set or a repeatable skill set, especially if it's profitable, right? If you have a profitable system, this is all it comes down to. And very simply, the main cycle that exists entirely is that you enter a trade, then you close a trade. That's really it. There's nothing more to your life / execution as a trader, right? You as a trader or as someone that is learning the skill set of being a trader are teaching yourself to find optimal moments to enter and then to close. There's no bag holding. There's no holding on for dear life, hoping that something comes back. There's no getting involved in a market because everyone and all your friends are in it, so you just really want to make some money. There's no getting rug pulled by a scam coin or anything because all there is an entry, a defined exit, and evidently a close through a loss or a close through a gain, which could be, any amount of gain, which is why as traders, we actually have edge or have an ability to grow our accounts because again, we create an unfair advantage in the markets in regards to what we lose and how we make money. So the real life cycle of a trade, we're going to talk about all these things in a second, all these steps in a second, is that at its core, as a trader, as your skill set of a trader, all you're doing is you're entering trades, and those are leading to closes. And those closes, which are then small losses or larger gains, will lead to reutilizing the money that you now have on your account into new entries, right? Or reutilizing the small losses that you took into taking new trades on your entry so you can gain more on your future closes, on your future trades. Like we spoke about in the last portal video where we said that being at break even and not taking losses and wins could be better than just taking, losses and wins, right? So you have less wins, but you miss some wins. But because of that, you have less losses, which means that your next win brings you up here with this system and brings you up here with this system. And of course, as we think about this, we start understanding why it's so important to sometimes manage your trades. Now, here we are. The real life cycle of a trade is ultimately coming down to the fact that we enter and then we close. And we repeat this over and over and over again. That's this. And then we have the optional choice of doing these other three things for the most part. We have the optional choices of moving to break evens. We have the optional choices of closing partials, which simply means closing a percentage or a certain amount of the position. And we have the choice to do trails, right? All of these, though, lead evidently to a close, always, right? One of the most important things is that we will always be closing a trade. We're not here to hold bags. We're not here to pray for deliveries. We are just here to take out our edge out of the market. Okay, so that's the life cycle of a trade. You can draw that, you can write that down, but this is all you're doing as a trader. And let's talk about those basics right here in reference to what you've learned before and walk you through it kind of step by step so you can actually start utilizing this in your own trading. So first steps first is entering a trade. What do you need to enter a trade? You guys already have it, right? It's the risk basics. You need to understand do you have the buying power to enter this? Do you understand how much -1 RR is on your account? What is that in regards to a percentage of your account? How are you taking that risk on that trade? How much are you actually taking on that trade? You have that all defined. Entering a trade simply comes down to knowing the risk basics associated with your actual account, and you already know how to do that. And most importantly, I kind of wrote this here because this is one of the most important things, is you enter with a stop loss. I don't care if this is a stop loss that's literally in the broker where you type it in, or if you have it mentally and then the second that prices hit, you close the trade entirely, right? I don't care how you do it. The point is that when we enter a trade, we are entering for the purpose of closing. We have to remember that. We are entering a trade not for the purpose of making money. We're not entering a trade to lose. We're not entering a trade to win. We're not entering a trade to break even. None of that is true. The only purpose of entering a trade is to exit it. Now, whether we exit it with a loss or exit it with a win doesn't matter. But what matters is that we have the intent to close. And hence, the first step of entering any trade is expecting, as I like to call this. I like to think and teach people that I've worked with, including you guys, to expect the loss, right? So this is very simply where we start on any trade. When we enter, we don't enter for the purpose of even thinking about a win or a break even. We enter with the intent to close the trade. And what that means is that because we're entering with a stop, our expectancy, or every time we enter, our intent is to actually expect a loss. It's to expect that -1R, because that's the likely event of a trade that we take. And when we're right, and only when we're right, or when things start to go right, or when we have other management things in place, can this become worth maybe less RR, or worth no loss, or worth a small gain, or worth a large gain, right? This is how we think. This is how over time you create a profitable system. So when we enter with a stop loss, we do so because we have the intent of closing. When we enter with a stop loss, we have the intent of expecting the loss. So we are no longer attached to the potential of a win, to all the money that we could have made, to the money that, oh my God, we ended up losing because we didn't have a rule to get out. Remember, we are not here to act like the idiots in the market. We are not here to be like the hedge funds that blow up, like the retail traders that blow up, like the dumb traders that blow up, like the people that invest in dumb coins and hold on to them to blow up, like the people that end up bag holding for years to blow up, whatever it might be. We're not here to do any of that. We are here simply to show up, execute a good trade, expect a loss out of the trade, take our -1R because we have our risk basics already worked out, and expect it. And in the event that that doesn't happen, we have potential upside because our downside is limited to a very small figure. This is how trading operates, right? So again, these videos here are acting both as a psychological stepping stone in getting a lot better and thinking about your own trades, but also showing you exactly how the life cycle of a trade actually operates. So we have our risk basics, we enter with a stop, and that is everything that comes with entering a trade. Now, the next step is breaking even. And again, we're going to have independent videos on these. So, you can see some of my own rules, but I'll do kind of like a simple breakdown for this video right now. And breaking even, everything else apart from closing and entering is completely optional, whether you want to ingrain it in your trading, use it in your trading, or not use it, right? In some cases, people that use it can do better for themselves with their overall expected value, with the money that they make. For other people, breaking even actually loses the money because it just tends to be the case that they just make a lot more money when they don't break even, right? To show you an example of how this could operate, I know I have Tesla open here. You can think about it this way. Let's say you're someone that has a system that's very, very basic, something like we go into a momentum MB on a higher time frame, price begins to break down, moves into an accumulation MB, and as it moves into momentum MBs on this time frame, you simply take an entry with a very large stop, like below, protecting an overall momentum MB of a higher time frame. And this is your entry on Tesla, right? Let's say you're someone that has a much bigger net worth. You don't want to spend the time getting these tiny little fractions out of the market or small or big RRs. You instead are here to get high quality positions on, manage your risk as a result of getting those high positions on, and make money out of them, right? This is an example of if someone has a $10 million account, right? And they're maybe risking anywhere from what would it be, 100K per trade, right? Maybe someone like this is more than happy to take 100K risk on something like this, and when it moves and makes the money like at a 1 to 3 RR, risk to reward return, they make around $300,000 on this trade. Now, in a scenario like this, right, your break-even rules might be a little bit more optional, right? Because when you allow for price to have more, or let's say like a much larger space, you might actually allow it to play around much more before you consider moving risk, right? Because in this case, if you notice, if you had used a rule where just because price went up, you'd move to break even, you would have broken even on this trade. And in some cases, that could be a fine thing. And in some cases, you might not want to do that because you missed this trade. But at the same time, you might have a rule to then get into the next trade that starts setting up, and this could have been your trade right after, right? So there are advantages and disadvantages to breaking even. I personally think there's much more advantages to take off risk, and you're going to see that, through all the things that I've shown, and even in webinars, one of my biggest parts of my edge is the fact that I break even really quickly. And ultimately, I'm only interested in the moves that really go, right? So like the way you can think about it is if I took an entry here, right? Like if I'm taking this entry, of course, for me, it's with a much, much tighter stop. If I'm taking this entry, I'm at break even on this trade at the close of this candle, right? As this candle closes, that's it, I'm at break even, right? So at that point, yes, price can come back and then go, and I might miss the move. But for me, right, if demand is truly validated and it's taken out through this, it won't come back. And then the strong moves will actually sustain themselves and go for an actual move. And that's okay. I'm happy with that risk, and I'm okay with taking the break evens and maintaining myself at break even for a longer period because I know it's preventing losses, even though it might be preventing some wins in some scenarios, right? But the very first thing is that you have the breaking even, and this is optional, right? And there's a few ways to do this. One of the ways to do this is simply to move your entire stop loss to break even. So wherever your risk was, you have your risk set because that's already determined by your entering a trade, and that's your step one. You have your risk set at some point due to something that happens with price. And for me personally, it's an E-micro move higher, like a proof of moving higher, or price just taking off, something along those lines, right? At some point, you have a rule to take your stop and move it to break even. This doesn't mean price has to be up a significant amount to move to break even. It doesn't mean it has to be up a tiny amount. It doesn't mean you have to wait till you're out of some of the position to move to break even. Simply, you have a rule to move your stop to break even. That's it, right? So for me, like if you can imagine this entry, so maybe price was doing something like this, right? Whatever. And then let's just say I took an entry through this high and I entered here. Very simply, right? If price does something along these lines, I'm already at break even. Now, at this point, you can already see that you might be up only 0.3 RR in profit at this point, right? So I want this to be a case because a lot of people think that the only time they should be moving their stop loss to break even is only when, their move has already proven itself and is very correct and you're up like a lot of money on it. That is a dumb way to think, right? Because ultimately the moves that are up a lot or the moves that end up working are gonna be the moves that end up working. And then what's the point of moving your stop after it's worked? Because the point of moving your stop is that when it doesn't work, you save money. So this is why I moved my stop losses to break even pretty quickly, because when this is wrong, right, and maybe it wants to reset up and I can take a new entry here or just fail, right, I'm simply at break even. And it's a market that doesn't end up going. And it's not one of those what I like to consider the perfect move, at least for me, right? Because what we're doing as traders is we're looking to develop, as we would like to think about it, the perfect move for an entry, right? That's what we're doing as traders. We're trying to determine what is the perfect move. So one of the ways that we can actually break even, right, is actually just to move to break even. And you can have a number of rules that leads to that, but that's what breaking even means. It means you take your risk off the table, you move to break even. Now, another way that you can break even is simply to close around the break even for a small gain or a small loss if price doesn't move right. Right, so a very simple example of this, just theoretical, and then we can maybe look at a real, is let's say, let's just say this is an E-micro, right? Maybe it comes down. So you already know that you want to buy stop this because on a higher time frame, it's a double MB or it's a worthwhile MMB to buy, whatever it might be. It doesn't matter, right? You said, okay, I want to enter here. All right, here it is. I want to enter. So one thing that you can do is, let's say you do get into this trade, right? And then maybe it starts to move, whatever, and then it kind of like drizzles out. And then maybe it's like this, something like this, right? What you can do is, because the move itself has not moved the way you wanted it to move, right? Because you already have an expectancy. So if we draw an entry time frame, let's just say the entry time frame looks something like this, right? Let's say you buy stop this high. Your expectancy when you buy stop that high right here is that prices are, right, going to do something like this when you're correct, right? This is ultimately demand validation, as we spoke about multiple times. And as it does this, right, price doesn't want to return, and then it can start a move, or it can come back to break even, and it's whatever, or it starts its move and becomes part of a very large runner, right? So this is what prices need to do. Now, let's assume you have a similar situation. So here's a candle, right? Maybe it builds another MMB. So again, like imagine, price flushes out, comes up, boom, and then builds this, right? So you want to buy stop it. And let's say you buy stop it. And then the next candle looks like this, right? And the next candle looks like this, right? So at this point, you know, maybe your entry price is here, maybe price is just at the entry price or a little bit below on this close or a little bit higher, maybe the candle closes up here. It doesn't really matter, right? At the end of the day, because the move is not moving in the way that you are used to it moving, or it's not doing what you expect it to do based on your trades, you can simply close your trade. So again, you don't have to have this exact rule to close exactly at break even, or you're fucking it up, right? Or you cannot do it, or because price is in a little bit of a loss, you cannot close it. It's complete nonsense, right? One of the ways that you can actually manage your risk is to say something like, if price doesn't move the way I want it to, I'm just going to close. Whether it's in profit or in drawdown, I'm just going to close. Or I might just move to break even at that point and let it do its thing. Because a lot of the time, when a move fizzles out or doesn't actually do anything like this, it then tends to just continue fizzling out. And then yes, it might work. And then yes, it might fail and then work, right? Or it might just fail. And again, in these kind of scenarios, because I throw up the luck to the gods, it's not worthwhile for me, right? So I'll just let that thing become a break even at either a small loss or a small win, because it's just not moving in the way that it should move. Or maybe like you start getting a move and then it just kind of, you know, it starts fizzling and you're like, okay, I'm not going to be in this, because again, fizzled markets tend to fizzle more. And you'll see this for yourself. But a good example of this, let's just find a random example that we can actually use of this, could be, you know, like this is already a break even, but it could be something like this. Okay, let's just say for whatever reason, you took a trade through this momentum MB or this double MB that was forming. You had a stop like set here, maybe under the entire low. Maybe you have a system that's more based on bigger stops, going for moves like this, right? You're expecting that as price takes out this high right here, right? You're expecting that demand should come in and price should start making a move. But instead, price wicks and comes down, right? At that point, you can already make the conscious choice to just close the entire trade right there. At like a minor loss, because it's still a break even. I would still count this as a break even. Or let's say you wait, right? And then the next candle does something like this. So now, like, again, the move that you're expecting through this point is not occurring, right? The setup that you naturally expect, which would be, let's say, something like this. Here we are, right? The setup that you naturally expect, where when you buy stop, prices basically have demand follow up and demand starts to pull through, where now it's like, okay, good. This is what I want to see. Now I can move to break even and then price can deliver if it wants to, right? Instead of that occurring, instead you get this kind of chop at the entry. So what you'll do is, like, instead of waiting for like, oh, but maybe price will go and then I can move to break even, right? Or fuck, I'm gonna hold on for dear life and if this wants to go, right? You can simply close at this price right here as price closes right there on this candle. And yeah, the loss is like whatever, an extra, you know, instead of 0 or -1, it's like minus 0.1 or minus 0.15 or like even less. I don't even know. 56 versus 5. Yeah, like minus 0.1 would be the loss here. That's still a break even. And in the future, you might get the same thing where, like, let's say the next candle maybe did something like this, right? You might just move to break even entirely or just close up here. That's all it means when I show you guys that, like, you shouldn't be thinking about potential closes or stops as like this. It needs to do this exact thing or I'm letting this thing lose, right? Unless you have rules around that, then it's perfectly fine. So close around break even for a small gain or small loss if price doesn't move right. Very simple. And then for another optional break even is, and again, I know partial link's coming up, but another way to think about breaking even, especially if you have a system that might have like bigger stops, or if you've noticed that a lot of the trades that you take tend to start, come back perfectly to the places that you traded and continue. What you can also do is you can simply take a partial, right? But then leave the stop at the stop loss. This way also creating a break-even opportunity, right? So what I mean by this is, let's say for whatever reason, you took this trade right here. This is a good example, right? Let's just say you entered this trade right here. And let's say you had your stop below the overall area here, over the overall accumulation MB of the higher time frame. And you had this MMB right here that you chose to trade, or this double MB that you chose to trade. So let me show you that. 1, 2. Let's just say you chose to trade this, right? And you had your stop down here. Now, instead of just when prices take off like this, moving to break even, another option that you can have is something like, I will take 50% partial, or even a 50% partial at 1-to-1, right? So again, if you take a 50% partial at 1-to-1 RR, what does that mean? That means you gain plus 0.5 R. Right, very simply. Now, what you could do in a scenario like this now is you could just hold the entire trade with a stop loss here and allow this gain to pay for that to actually end up as break even. So for instance, if prices now came back and took you out at this price, what would that mean? Well, you would lose minus 1R, but you only have 50% of your position on, so you'd lose minus 0.5R, right? You get minus 0.5R, which means that you can see this is another way to break even or think about break evens. You'll fully end up being break even on that trade, right? That's if it came to lose. But in the opposite scenario, because you're using a larger stop and you're aware prices can come back before going and you're looking for larger moves, right? You can now hold on. And if price doesn't stop you out, which it doesn't here, you can see it goes, comes back to price, but you don't end up taking yourself out of break even. And then demand truly validates maybe somewhere around here or up here, because then it never comes back, right? Because again, remember, multi-time frames, price can come back as it did here, and then the move can start, right? And this could be your gainer on your account or whatever. And then great. And then you can take your next partial into whatever rules, right? Maybe it's some higher highs, higher lows. Maybe it's just the overall Mentimex structure indicator, and you just throw your stop here and you wait. And then if it starts going, then you'll move your stop higher. And then if it starts going, then you'll move your stop higher. And then if it starts going, then you'll move your stop higher, etc. Right? And you can do something like that. But that's another way to break even or think about break evens, right? It's not, so there's many ways that you can make the results that you start getting or the data collection that you start taking in work in your favor, right? You're not limited as a trader, which is a beautiful thing, right? You're not limited to any one thing. You can simply work around what works for you, which is a very, very powerful thing. Okay. So that's breaking even. And that's an optional thing to do. But again, it's something that can add a lot of money to your bottom line, and that's how you can do it. Now, partialing. Partialing is also completely optional, but as you've already heard me talk about this a few times, this is simply closing a portion of the trade at any point. Whether that means you're closing a portion of the trade for the purpose of breaking even later, or like letting price come back, whether you're closing a partial at a certain RR, whether you're closing the partial because you had a very crazy move, whether you're closing a partial because you have a trail rule for closing partials, right? So one of the ways that I've been usually personally closing partials, if I open up Tesla here, if I go to a 65-minute, one of the ways that I've been closing partials is I've been simply using the low of a candle. So for instance, I'll wait for a real move to kind of begin. And as it begins, right, as you get a kind of a big move, I'll then start using the lows of a candle, right? So I'll use the lows of this candle to exit 50% of my position. But then price pauses again, so I'll use the low of this candle to exit 50% of my position. And you can notice my first partial on this move here was actually just below this candle. So again, it's a way to partial along the way, right? So I'm partialing or closing a piece of the position. Other ways I've seen people close pieces of their position is just to simply say something like, I will close at 1 to 10. I'm going to close 50% at 1 to 10. I'm going to close 50% at 1 to 2. I'm going to close 50% at 1 to 5, at 1 to 20, whatever it might be, right? So this is going to be a lot to do with your data collection, which is in the data collection section of the Discord. So that's for you guys. You can go check it out. You already have it. You already have access to that. But that is one place to, those are things you're going to determine based on the kind of moves that you tend to get. Right. So for me personally, right, I'm just using the low of a candle, literally, as strength comes in to move a partial and to take a partial. So, but partialing itself, and not, again, it's an option or it's part of the life cycle of a trade where you'll enter a trade, you'll move to BE if that's a rule. If it's not, then you'll partial if that's a rule. If it's not, then you'll trail if that's a rule. If it's not, then you'll close, right? Everything will always come down to a close, but you can do multiple things in between to improve your potential management, your own psychology, and your own results in trading. And again, partialing is optional, right? That's simply where you close a portion of the trade. So this is an example where I closed a portion of the trade. I'm currently, I was in this BitX trade back, where is it? I have to re-put it on because I hit it. There we are. Right, I was in this BitX trade right here. And again, same thing happened. So when I traded this thing off of this double MB right here, off of this first candle right here, I had a stop right here at the candle low. Then I waited a little because this was whatever, and then we had this nice candle, so I threw my stop under this candle low. This nice candle, so I threw my stop under this candle low. Then you had this candle, and I probably could have thrown my stop under this low, but in this case, I just left it at this candle. After this up candle, I threw my stop under this low, or 50% partial under this low. After this candle, I did not do anything. Actually, I waited just like here. Then after this up candle right here, I threw my 50% under that low. And then this candle right here took out 50%. And I got stopped out at 50%. And then the rest, I used my other rules to trail it, right? I had an sell originally here, and then I moved it up to here. But that's another rule. But this is partialing. You close a piece for whatever reason. And again, you need to have rules behind whether you're going to close a piece or not, or how much RR, or over how much RR will you close a piece or not. But it's a way to take some money off the table. So that's partialing. Now you have trailing. This is also optional. And trailing is very simple, right? You can either trail a stop to completely get out, right? So that's closing. You're going to trail a stop, which means simply as price begins to go, you have some rule to take your stop loss and move it higher. Whether that's because price is making higher highs and higher lows and you move it higher, whether it's an indicator that you use, like if there's a 20 EMA here, you'll just trail with the 20 EMA, 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 and then get stopped. Whether it's trailing with the actual candles after they make a big move like this, right? Maybe it goes, makes a big move, then pauses, makes a big move, you stop, right? And then you can trail that way and get out of the trade like that. So these are trailing. Trailing is simply moving a stop up behind some indicator or some version of price until you get stopped out, right? And similarly, it can be used to get a partial. So you can see these kind of operate together. They all work together in some way, right? You can trail a partial to get out of a piece. That's actually what I do, right? I trail a partial behind price to get out when it truly breaks down. And then I trail the rest with basic higher highs and higher lows like this. And then that's where I got out right here at this higher low to get out entirely of the trade. Now I probably should have moved it even higher up. Like I could use this higher low here, but I didn't. And I got stopped out here for the rest of my position. So boom, boom, stopped out entirely. And then a new little move started, now it's down here, and I'm actually waiting to get inside this again, right? So I'm waiting to actually take a trade on this because, well, I think we're in a good spot to actually take a trade. Right? So here's a little bit of utilizing the concepts in action, right? But trailing is, again, an optional thing that you can do, and there's only a few ways to do it. You can trail a full stop to get out of the trade, or you can trail a partial to get out of a piece of the trade, or you can trail multiple partials to get out of pieces until the full trade is closed. And then, very simply, at the end of all, as always, you have an actual close. Because every trade is going to end in a close. We enter a trade with the expectancy to close it. We actually enter a trade with the expectancy to close it through a loss, but we actually enter a trade to close it, right? And closing is very simple. You close the remaining position or the full position. So either you have a remaining position because you took partials before, or you trail the partial before, or you close the full position if you didn't do some of these, or if you didn't have a reason to do them, and you close your full position entirely, right? So this could just, and as an example, this could be as simple as if I didn't take partials here and I simply trailed or got into this trade, and then, maybe my rule is very simply to always close at 20 RR. So simply I enter this trade, I do nothing, 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 and right there, as price hits 20, I close my entire trade, right? That's another way to trade. That's another way to make trading work for you. What I've noticed is some people on lower time frames do something like this, where they just take a 1 to 10 or 1 to 20 or 1 to 50, and they just allow that to be their closure, right? These are all valid ways. But what I really wanted this specific portal video to focus on is improvement in your own psychology, expectancy regarding how we enter with already knowing what our risk basics are. We enter with our stop. We expect a loss because we know it actually makes us money over time. And then we have the benefit of choosing how we can also use these optional management techniques in our trading if we want to use them based on what we've seen from our own data collection, right? And this is how you can think about them. So that's it, really. This is the whole management and the life cycle of a trade, right? And now we can talk about specific management in terms of like more examples in my own trades, but this is ultimately what it comes down to, okay? Beautiful.